This Twin Peaks Investing Podcast is brought to you in association with ShareScope, the UK's #1 investment data and analysis software for private investors and traders. Visit sharescope.co.uk and discover the advantage.
Hello and welcome to the Twin Peaks Investing Podcast. This is podcast number 173. And for you and all of you that are looking on YouTube, you'll be able to see that we've got a guest with us. We've got former fund manager Charlie Huggins. I think today he could be in Bristol. He could be up north. I'm not quite sure where he is, but he is at home.
Yeah, I'm in Bristol.
Fantastic guest. Co-host Henry Viola here. It's not a guest. He's always here with me. But got to say a big hello to Charlie. Charlie, where are you today, mate?
Yeah, Bristol. That's where I live in Bristol. Yeah, just in suburbia.
In suburbia. And where are you, Henry, today?
I am still in London, Peter. I've not been picked up by the international fund scene yet.
Brilliant. Right. Okay. We're going to focus this podcast today on introducing those of you that are not aware of Charlie as to what he's done historically, where he's worked, his thoughts on the markets, all the travails that the markets are going through regarding AI now, and talk about some of the stocks he likes and maybe some of the stocks he doesn't like. So we're going to do a little mini interview and then get into the rudimentaries of the markets. This is going to be a real masterclass on investing for you, ladies and gents, that wherever you are in the world. Firstly, Charlie, thank you for joining us and blessing us by coming on this pod with us. You and I have spoken before and I've interviewed you before, and you graced Master Investor Show with me as well previously. So thank you for coming back. I've not, burnt any bridges with you, so that's a good thing. Yeah.
No, you've been a great support for me, Peter.
You're welcome, mate. You're welcome. Right. Okay. Let's start with your background. Say you're a former fund manager. Give us your history from uni, first job, to Hargreaves, to the last job, to what you're doing now, and then we'll ask you a few questions in between, please.
Okay. God, it's going back a bit, but it's so from university, I joined Hargreaves Lansdown on a graduate rotation program. I think that was 2011. Did that for a couple of years. Worked my way into the investment research team. Did initially research focused on funds and investment trusts. Evolved then into equities. Did equity research. So writing notes on the most common shares held on the Hargreaves Lansdown platform for clients, and then we decided to launch equity funds. So until that point, Hargreaves Lansdown had only really sold other people's funds, but we decided to launch our own. So we launched a couple of UK focused funds, a UK income and a UK growth fund, and I ran that with another chap that we brought in for 5 years. I think for UK growth was the first one to launch, ran that for 5 years, and then UK income similar. And then left to join Wealth Club and went to set up a global equities portfolio for Wealth Club, which was a 15 stock, highly concentrated, as I say, global equities, quality focused. Did that for a few years, and then at the end of last year, I decided to go it alone and become a private investor and blogger.
Brilliant. Now, I want to encapsulate some of the stuff that you said there as to what your greatest learning was and is from your time essentially running institutional monies, because it's a big responsibility. And I think sometimes as private investors, we say, oh, these ladies and gents are really just don't appear to be doing a lot, but there's a lot more to it than just buying a stock and just watching it and just generating returns from it.
Yeah, I think until you've actually run money professionally, it's hard to envisage what it's like. And it's easy to look at fund managers and think, oh, why are they doing that? Why are they doing that? They should be doing this, making so many mistakes, whatever. I mean, probably the biggest learning is that it's extremely hard to be rational as it's extremely hard to be rational as an investor anyway, no matter what investor you are. But as a professional investor, you have a lot of pressures from investors themselves, from risk committees, from compliance, from the firm that may want to go in a certain direction different to what you want to go in. It's extremely hard to be long-term focused. You've got all the regulations to deal with. There's certain stocks that you may or may not be able to buy. You've got daily inflows and outflows. You've got potential liquidity problems. So running money professionally is actually really, really difficult. And it's very hard to remain long-term focused and rational. And that's an area as a private investor where potentially you can have an edge over the professionals.
Excellent reply. I think Henry might have a question for you there. He's been itching there. Go on, Henry.
Yeah,
I know you're
I was going to say,
on.
you banged one of my questions straight on the head there, Charlie, because I was going to ask you what you think one of the biggest constraints professionals faces. So as a bit of a follow-up to that, what do you think changed the most for you when you went from running professional money to managing your own?
I think it's probably being able to be more long term. I mean, I always tried to be long term as an investor, as a professional investor. But there's this big thing called career risk, which every fund manager, well, not just fund manager, every employee faces, which is I don't want to lose my job. So if all the AI stuff is, for example, right now is doing really well, it's very hard to be a Nick Train or a to be a Nick Train or Terry Smith and say, you know what, we're going to sit this one out and own all the stuff that's going down. So professional fund management largely is a game of trying to guess which share prices will go up over the next 6 to 12 months. And that's a really, really hard game to play. And to be honest, I avoided playing it, even as a professional. But you realize when you do it how hard that is.
Gotcha. And so, you've sort of answered my next question in reverse, which was really around the advantages that you think retail investors might have. So a lot of the audience we've got listening to the podcast are retail investors. They're not institutional. And they tend to come in for a lot of flack from institutions for not knowing what they're doing and not having the information, the technology, and the insight. What's the biggest advantage, though, that you think retail investors have actually got over the professionals, other than the sort of lack of constraint around what they're doing?
I think not answering to other investors means they can play their own game. If you've got a stock in your portfolio that's going down or whatever, you can just sit on it and you don't necessarily have to do anything. And similarly, if you've got a stock that's going up, you don't have to do anything. You as a professional, you're always being told, trim it. Don't let that position get too big. Don't. So there's those kind of constraints as well as the regulations. But it's interesting what you say about information. Professionals definitely have access to more information in terms of stockbrokers' notes every day and bombardment of, Jefferies say this on this stock and JP Morgan say this and whatever. So they get so much information and professionals are expected to know so much about the companies. But is that an advantage? It does sometimes that make it harder just to stand back and say, yeah, there's all that information, but all I've done there is just drummed this idea into my head as much as possible. I know everything about this business, but I'm never going to sell it because I think that I know everything. Yeah, maybe there's a humility that private investors have to say, actually, I don't know. Whereas as a professional, it's very hard to admit. Professionals, I think, often find it hard to admit when they don't know something. So because they get so much information, they're supposed to know everything. So ironically, having less information as a private investor may be better, and it may also be slightly easier to cut through the noise. But it's also very hard as a private investor to cut through the noise, let's be honest. But yeah.
I really like that. I mean, Peter and I talk about researching a lot on the podcast. And actually, that one thing I've never particularly struggled with is saying, hey, look, I don't know, or I got it wrong. And actually, when you watch professionals, that's something that they almost seem terrified of admitting. It's like they're going to get fired if they say they got it wrong or they didn't know.
Yeah, absolutely. It's
Really
very
hard.
hard. It's very hard to do behaviorally, but I think if you're a very well-paid fund manager and you keep on making mistakes, which you are going to do as an investor, you're going to keep making mistakes. You just need to learn from it. You need to rub your nose in them. That's what Charlie Munger always said: rub your nose in your mistakes. And maybe it's easier to do that as a private investor than a professional, because, as I say, if you do that too many times as a professional, you might get fired because people say, "Well, you don't know what you're doing." Then the reality is, does any investor really know what they're doing? I mean, we're all making it up as we go along. We're all dealing with incomplete information, and we're all trying to deal with our own emotions and invest. Humans are not designed to invest. They are simply not designed to invest. So you battle that every day. It doesn't matter whether you're Nick Train, Terry Smith, or a private investor.
I love that response, Charlie. You touched on this, and this is something I think, despite all my research and knowledge about, is that you're being judged on the benchmark. Obviously, I know that. You're being judged on the performance. Obviously, I know that. But you're saying that you're being judged almost on a 6-month to 12-month basis. But all the talk from the market and what Henry and I and everybody else listening to this podcast have been told is that fund managers are meant to be looking long term. And long term to me means 5+ years. It's not as in some people's sort of metrics now, 5 to 6 months.
Yeah, but I think retail investors are part of the problem as well, because if they own a fund, they expect it to go up. They don't want to own a fund that goes down. All the market's going up and their fund is going down over 6 months, 12 months, 2 years, 3 years. So there is a lot of short-termism around from every investor, as I say, because of those human emotions and biases. And that does make it very tricky. But that's just the way we're wired, unfortunately.
Okay, so you touched on the fact of you've got the compliance individuals, you've got the risk management teams, you've got all these different things that are constantly over your shoulders going, Charlie, what's happening with this? And Charlie, what's going on with that? You've got a stock in your portfolio as a fund manager and it's doing well and there's no noise around it. And the market's just allowing it to just go where it's going and it's doing extremely well for you. It gets to a certain size and you've got a significant amount of profit in that particular stock. Are people then having conversations with you as a former fund manager saying, we need to capitalize on that now, we need to bank some of that now, where you're thinking, crikey, this is only just getting going?
Absolutely. I mean, the risk team will knock on your door and say, "Oh, that position's getting a bit big. We don't want a lot of the less risk as a professional is to look more like the benchmark." Now, this is also a distinction between private investors and professionals. If you ask pretty much every private investor and say, is your portfolio outperforming the benchmark over the last 3 months or 6 months or whatever, they probably won't even know. Because if you think of your portfolio, what you have in it, cash, bonds, equities, different sorts of equities, UK equities, maybe global equities, you're not benchmarking yourself every day or every quarter. And I think that's healthy. Whereas professionals every single day are looking at Bloomberg and saying, am I outperforming today or not? And that is really unhealthy because it just leads to really short-term behavior.
Every day, Charlie?
Oh, every day, yeah. Every single day, a professional, the majority, at least every week, but most every day, will look on Bloomberg and say, am I outperforming or not? And if they are, they'll go home happy. And if they're not, they'll go home sad.
That seems like a recipe for drinking an awful lot of pints.
That is not healthy. No,
no. I mean, I have to say, I was always been quite unconventional, and as a professional investor, I very rarely looked at Bloomberg. But a lot of professionals do live on Bloomberg, and Bloomberg is the bombardment of information again, and they can tell you every single stock, how it's performing on any given day, how it's performing relative to the benchmark, how the portfolio is performing relative to the benchmark, and none of it matters really. If you're investing, none of it matters. If you're speculating, it matters, but if you're investing, it doesn't matter.
Okay. Let me ask you something positive now, Charlie. Then,
yes.
So with regards to the investing side of it, and being a fund manager and that job that you worked so hard to get initially from that the initial position you had at Hargreaves to running money to then being headhunted to work at Wealth Club, what was your favoured and preferred and most enjoyable aspect of being a fund manager?
I think it's a fascinating job in terms of you've got to know a lot about what's happening in the world, whether it's AI now, whether it's oil, commodities, whether it's anything. I mean, you've got to understand as a fund manager, you're a generalist. You're a generalist. So one day you might be looking at Shell, the next day you might be looking at Relx, the next day you might be looking at a house builder. They're all very different businesses, and you've got to know sort of how the world works a little bit, and how industries work and how businesses work. If you're doing the job well and you are investing for the long term, understanding how businesses work, and how it all fits together, and how what's happening in the world impacts on businesses, and all the behavioural biases that go into businesses as well in terms of management behaviour. And so it is a fascinating job, investing. And yeah, there's always something happening. Even if you're a buy and hold investor, happy to sit and hold, there's still always something going on, even if you're not necessarily trading yourself.
Great, I love that reply. Henry, over to you, mate. You had some questions to ask on that topic.
Well, I mean, we've talked a little bit about your sort of background coming into the industry and then transitioning into managing your own money. I'm really curious. So you've had a couple of jobs now at a couple of different fund houses, and now you've got your own sort of fund that you run. Could you describe for our listeners your end-to-end investment process? How do you go about generating your ideas all the way through to the day when you eventually, hopefully realize a gain in your portfolio? What does your system look like?
Great question.
It is a great question, and I'm not sure I have a great answer for it, to be honest. A lot of managers may use screens, and they may have very elaborate research processes that they follow, I suppose. My approach over the last decade, 10 to 15 years, has been to read company results. So every morning, I read all the UK results that come out, as I'm sure that many private investors, many investors do. And over time, you get to know those businesses pretty well. Obviously, I do that with a number of global ones as well. I am most familiar with the UK market, though. And if you do that for long enough, every single day you sit there and read company results, then you get to know, okay, that business is worth following, or that business, every time it opens its mouth, there seems to be a problem. Or you also spot patterns over time. And by looking at the accounts, you can obviously see, okay, these guys account conservatively, these ones don't. So it's just an awful lot of reading, really, on reading company results. Obviously, spending more time on the ones that I'm more interested in. And if you follow a business for a decade and you've read every single quarterly report that they've put out, and every annual report, then you'll get a decent level of knowledge on that business, and you'll be able to spot, hopefully, the warning signs, shall we say, if things are going to start going wrong, or if things are going well, you'll know hopefully why, and you'll get to know whether there's competitive advantages that a business has. But in terms of what I'm looking for in a business, I mean, the main thing is barriers to competition. That's the thing that kills businesses. It's competition. It's not how quickly a market grows, as many people seem to think. That's nothing to do with it, really. It's because you can have a market that's growing really, really quickly, and if competition comes in, then you don't have a business. So you want ideally you want the market to be growing, but fairly stable, competitive environment, and a business that, in the words of Buffett, has a huge moat around it. But a moat isn't a static thing; it's an evolving thing, and you want a business ideally that is getting better over time, and that's where it's very tricky because most businesses are not getting better. I think Charlie Munger was once asked, how many businesses do you think get better over the course of a 5 or 10 year period? And I think he said 1% of businesses might be better in 5 or 10 years' time. So very few businesses actually get better. If you can find a business that's getting better, then you'll probably make a lot of money in it. but it's finding them. They're not easy.
Yeah, I think that's a really sound point. I mean, there's this assumption that as businesses get bigger, they're getting better. And I talk about this quite a lot. If you've got a company whose earnings per share are growing over time, in theory, then I forget who it was. It might have been Nick Train or Peter Lynch. The earnings per share go up over time, then over theory, the share price will follow it and you'll do well. That doesn't necessarily actually mean that the business is getting better.
No.
One metric that you as a shareholder can watch. And so I kind of wanted to ask you about, valuation metrics as well. So you're reading these RNSs, you're looking at what the management team is saying. Are there any particular sort of quality or valuation anchors that you rely on as a good indicator of these quality type businesses?
In terms of valuation, for me, it's really simple. So any asset that you're going to value is always valued based on cash. So cash is the only thing that matters. Whatever the asset is, okay, not things like gold because they don't produce any cash, but any cash flow producing asset, you're looking at how much cash does it produce this year? How much cash has it produced in the past to give you an idea of its level of cash generation? But most importantly, how much cash do I think it's going to generate in the future? And that's basically just a discounted cash flow model, if you want to call it that, which it is. And every time I look at a business, I'm making an assumption around what's the level of cash flow, how much do I think the cash flow can grow or decline? If it's a declining asset, you can still value a declining asset, and then apply a terminal growth rate after 10 years. Obviously, apply a discount rate, which is basically the return that you would hope to achieve from the asset. And that's all investing is. I mean, anytime you invest in anything, that's what you're doing, whether you realize it or not. Earnings per share, PEs, price to book, all of this stuff doesn't really matter. It's cash that matters. PE, price earnings, is a shorthand way of getting to the cash generation. And if the earnings flow perfectly into cash, that's fine. And PE and cash flow becomes equivalent. But businesses vary hugely in their level of cash generation. And that's something that I think investors probably don't focus enough on. But if you read Buffett, Munger, all the best investors, even Terry Smith and the likes, they always just talk about cash because that is the thing that matters.
This is a quick hello to you, our valued Twin Peaks Investing podcast listener. Whatever channel you're listening to, please make sure to subscribe and you'll always be the first to get the new episodes. Thank you for your continued support.
I really like that. And that's an answer we don't hear very often at all, actually. So that's a really insightful comment, in my opinion. Thank you.
I mean, it's just if you own a rental property, then the return that you're going to get from the rental property is how much rent am I going to be paid by the tenants over the next 10, 20, 30 years. And that's all you're doing with a business. You're saying, okay, how long can this business last? Because businesses don't last forever. And how much cash can this business return in that time? It doesn't necessarily mean they have to return it all as dividend and buybacks. They can reinvest it, and then that can grow the future cash generation. That's fine. But that's all you're doing when you buy any asset.
So Charlie, let me ask you now. This is more related to the markets as we're currently facing, and it's going through a lot of flux at the minute with all this AI noise and Anthropic and all the other stuff that's coming out. I'm reading a report today that's basically saying that Apple's going to be next to come out with an AI something or other. So essentially, we've got these blue chip stocks, or thereabouts, FTSE 100, FTSE 250 stocks that were beloved, 6 months, a year ago. Yeah, you've written about a few of them, which we can talk about in a few minutes. That were sitting at multi-year highs 6 months ago, 3 months ago, even. And there's been a cohort of them that have been essentially been smashed in half. So now people are running numbers which they don't really know about and saying that the terminal rate on this company now is X and the share price has already gone down 30, 40, 50%. And my question is, with regards to AI and all of this debacle regarding mainly FTSE 100 stocks, but also US tech stocks, how do people make such a very short-term judgment on the health of the company purely because a competitor has come out with something that says we could probably be doing aspects of what you are doing now. Aspects, not the complete universe of your solutions, but aspects of. How does that happen so quickly with the speed?
Well, there's a few things to say on AI. I think we are in a very irrational market at the moment where the focus is exclusively on AI, and the idea is that AI can take over everything, and everyone thinks AI is transformative. The same thing happened in the late 90s with the internet, and of course that was proven right. The internet was transformative, but the internet didn't disrupt every business. It disrupted some businesses, but it didn't disrupt every business. But sometimes the market gets like this, where it gets myopically focused on one single thing, and it all becomes very black and white. It all becomes, you're either an AI loser or you're an AI gainer. And business does not work this way. It's not black or white. It's very, very grey, and it's very nuanced. But investors, at times like this, when there's a new technology that comes along, they shoot first and ask questions later. And we are seeing a lot of irrationality and panic, I would say, in certain parts of the market. I think we're seeing irrationality and panic from the Magnificent Seven in the US, from the likes of Microsoft, Amazon, those Google, the amount that they're spending on AI. And I don't know about you, but I haven't seen a single business say, this is the amount of profit or cash that we expect to make from our AI investments. This is the return on capital that we expect to make on our AI investments. I haven't. Well, yeah, I mean, I think I always draw a distinction between, is this company spending money because it wants to, or because it feels that it has to? And I think with AI, we're not seeing any companies invest because they want to. We're seeing companies invest because they feel that they have to. And if you're allocating capital with a gun to your head, effectively, then the likelihood is you're not going to, if I put a gun to your head and say, right, buy the first thing you possibly can, you probably wouldn't make a great decision. And that's what we're seeing with AI. We're seeing these huge panicked investments, which will, to my mind, almost certainly destroy shareholder value. We saw the same thing in the late 90s. So the history doesn't repeat, but it rhymes. With all that being said, AI, and you said it in your question, Peter, AI is a risk to the terminal growth rate of a business. It isn't a risk for the earnings over the next year or two. So when Relx comes out with really good results, and and you read them and you think, God, this is amazing. These are brilliant results. Well, there's not really any impact from AI. There's not really impact from Anthropic's launch of a legal AI plugin on those results. And there probably won't be for the next couple of years, because a business like that has long-term contracts, and it has very strong relationships with customers, and it has all these things. But could it be disrupted in 10 years' time? The chance of that has gone up because of all this irrational AI spending. And the longer the irrational AI spending lasts, the higher the chance of disruption. So that's what we're seeing. We're seeing investors say, with software businesses or data businesses, you know what, I'm not so sure anymore about the terminal growth. When I do my discounted cash flow model and I say this is going to grow at 2.5% beyond 10 years forever, I'm no longer so sure of that. I mean, I may not even be sure that the business is still going to be around in 15, 20 years, because what will AI do? Yeah. I'm not saying that's right. I'm just saying that's the questions that investors are asking.
Yeah. And I think you've used the word several times already. It's the irrational behavior. There's no more rationality left. It's almost, they're panicked, and I'm saying I had lots of conversations with various people sending me DMs and elsewhere and all the rest of it. And Henry and I have discussed it on here. And I'm saying, Relx have been using AI for a long time. They have this I forget the number now, of actual legal skilled professionals and lawyers that work within Relx. Yeah. Then there's no one's overnight suddenly going to go, let's just plug Anthropic in there and let's deal with this in court. It's not going to happen.
No, I think with a lot of these businesses, software businesses and data businesses, um, the risk of disruption has obviously increased with AI. AI does pose a risk to certain businesses, and it's very hard. No one can say at the moment how much of a risk. No one can quantify it. No one knows. No one knows how AI is going to play out. So it is definitely a risk for some businesses. On the other hand, you look at some of these businesses and so for example, a Relx, and you say, yes, it could be disrupted by AI, but as you said, it's got many different competitive advantages that will make it hard to disrupt. Not impossible, but hard. And probably even if it was going to be disrupted, it would take a very long time. So decades, I mean, you look at the internet in the 90s, how long did that take to start impacting retailers with stores? It was probably not really until 2013, 14, 15. So probably 15, 16 years after after everyone was worried about it.
Yeah.
So I suspect AI will be similar. This is going to play out over a very long time.
Yeah.
But the danger with this for investors is that you can't put the risk to bed in the next couple of years. No company can come out and say, you know what, we've realized AI is not a risk at all for us, because it's a risk to the terminal growth rate. It's a risk 5, 10, 20 years out, not a risk for the next couple of years.
Yeah. So going back to the point that you made just earlier, the Googles of the world, Metas of the world, etc., they're all having this conversation, and Henry and I have discussed this so many times. So they're all piggybacking on, we are throwing $50 million billion dollars into AI. The whole, they're heading towards $500 billion that they're all invested thus far, if not more. So everybody seemed to be having to be on that bandwagon, right?
Yeah.
So back in the late 90s, as you said, it was a case of, oh, we've got .com on our name now. The shares go off, right?
Yeah.
Or we put an e-commerce site on our website. The shares go up. However, now everyone's going, okay, so what? You've added a bit of AI in there, and you've added a bit of AI there. Now saying, as you've said, Charlie, what difference is it going to make to your revenue? What's it going to make to your profitability?
Yeah. Well, profit is, because revenue is users is one thing, revenue is another thing. The other thing we're seeing with these AI models is intelligence of AI models.
Yeah.
So you look at the large language models, which are losing money, so much money at the moment, and will continue to lose so much money for the next few years at least. And it's all about, can we come up with a more intelligent model? That's what they're trying to do every day, is come up with a more intelligent model, and that's great for society, and it's great for the evolution of AI in the long run. But it has nothing to do with profit or return on capital, and capitalism always comes back to, well, cash
and profits. Yeah,
profit and return on capital in the end. And these periods don't last forever. In the late 90s, it was eyeballs, and it was hits on websites, and it was all this. People always come up with useless, stupid metrics that you should be focused on, but it all comes back to cash in the end. At the moment, cash doesn't matter, but it will at some point.
Well, it does. I have to disagree on that, but it does, because that's the reason why you've got X, Y, and Z coming back into the market now and doing 100-year bonds. Exactly stuff that's going on. So cash does matter. They're building up the debt because they want to invest even more. But I want to give you this example, Charlie, because I'm conscious that Henry's got loads of questions for you. Right at the beginning of this decade, right, the 20s, okay, it was all about Apple, right, and the growth rate of Apple and the massive moat that they had, right. And it was a go-to stock. We get to the mid-20s, 2025, it's all about Nvidia, right? GPUs, etc., etc. We go back to from Feb 2026 to Feb 2025, that 12-month period. One of the highest performing stocks that's outperformed both Apple and Nvidia is Walmart.
Oh, Walmart, yeah.
So you've got this AI bubble going on, and it's Walmart that's outperformed both of them. I'm sitting here scratching my head going, what's going on?
Yeah, and CostCo.
And Costco, yes.
Costco's another one. that has performed really well, and the rating, I mean, it's traded on about 55 times earnings or something.
For a
And Costco is a
retailer.
great business. Costco and Walmart are both really good businesses. This is the other thing that we've seen in recent years. We've seen a bit of a quality bubble, to be honest. We've seen very, very high ratings attached to so-called quality businesses. And the AI disruption has knocked those valuations right down for a number of the businesses. But if you're a quality business that is not supposedly being disrupted by AI, then you can still see a really, really high rating. It just feels to me very late cycle. It's all everything doing well right now is mining, it's cyclicals, it's AI, it's and the stuff that's not doing well is obviously the established cash generative businesses. It's things like consumer goods and healthcare, stuff that people just don't really want to own. And you see it every time at the top of an economic cycle. I read something the other day that said 90% of bonds in issue at the moment yield less than 5%. That's another warning sign of people just who's worried about a big recession at the moment? Probably not very many people. People think, oh, the US economy is going really well. We got through COVID, we flew through even the tariffs, they didn't really seem to have much impact. But at some point, we will have a big recession again. And probably focus will return to cash again, because it always does in a recession. But yeah, I just think, I mean, the Walmart thing is interesting, but I think part of the answer is that it's not probably, people don't think it will be disrupted by AI, perhaps. So they're willing to pay a high multiple for it still.
Okay, cool. Thank you for that reply. Henry, over to you, sir.
Yeah, I mean, I love that, Charlie. I think you've made some really insightful points there. I want to sort of swerve a little bit from the specific conversation about AI here and talk a little bit about portfolio management. So,
yeah.
As a professional fund manager, presumably you've got some quite strong guardrails. You know, you've talked about risk management coming around and going, or you trim that now, or you're out of the job. As a private investor, you don't really have that, other than perhaps your wife giving you a kick in the shin if the portfolio goes down too much.
You just don't tell her. You just don't tell her.
I wondered, how do you view risk now that you're running your own money? How concentrated is too concentrated, and how do you go about sort of position sizing?
I think the first thing to do with risk, or the most important element of risk management, is in the types of businesses that you own. It's nothing to do with position size. It's do you understand what you own? Are you comfortable with what you own, such that if it falls by 30, 40, 50%, you're happy to stick with it? Or will you at least understand and recognize the warning signals for if you need to get out? So understanding the businesses you own, and for me, just owning, I mean, it's ironic actually, fairly low risk businesses, but the market is saying on some of these like Relx, oh, it's a really high risk business. I don't think it is. Owning businesses like Relx, where I think, you know what, it's extremely diversified, it's extremely cash generative, it's got multiple competitive advantages, it's sensibly managed. I think that is the biggest way that you manage risk is by, and it's not very sensitive to the economy. So I tend to avoid very cyclical businesses, very indebted businesses. I don't really own commodities or house builders or very cyclical industrials or anything like that. So that's or any business that could easily be disrupted by competition. So that's the biggest way that I manage risk. In terms of position sizing, I think if you've got good businesses that you know, or that you're confident will stand the test of time, you can afford to run them a bit higher in terms of weightings. If I had 20% in Taylor Wimpey, 20% of my portfolio in Taylor Wimpey, I'd probably have sleepless nights. But having 20% in a Relx or Diploma or Experian type business, that to me that feels okay, more comfortable. I'm not saying I would necessarily go to that level with it, but I mean, Diploma is a business that I've owned for years, and I've never sold a share of it, and it's probably 20. It probably is 20% of my equity portfolio now. It's not 20% of the overall portfolio, like if you include cash, bonds, and everything. But in terms of the equity portion, it's probably 20%. But I feel fine with that in terms of the business that it is.
I really like that. I mean, I'm quite similarly minded. If you've done your research and you know what you own and you're comfortable with it and you've met the management team, it seems madness to me to be chopping and changing and slicing and dicing it every 5 minutes. I don't know whether I'd be comfortable with 20% of my portfolio, say, but certainly a larger weighting than 2-3%. Because sort of end up with over diversification if you're not careful.
Yeah, I think you have to be mindful of valuation risk. If a business has gone up a long way and is trading at a say like a Walmart or a Costco, if I owned 20% in Walmart or a Costco, I would probably be looking to trim that to reduce it given the valuation currently. But then it's had a high valuation for the last few years. So, but generally, I do like to run winners. And if the business is performing well, and as I expect, it seems madness to sell it really, as long as the valuation remains reasonable. At the same time, I do think diversification is important, and especially as a private investor, if you're relying on your portfolio for income and to help sustain your lifestyle, then you don't want it all facing in the same direction. So having a mixture of assets and different sorts of equities is helpful. I've probably got more in the sort of data and software stocks that have got hit recently, but that's why I have the cash and the bonds and the boring REITs as well, just to balance it out a bit.
Yep, I really like that. I mean, I want to ask a quick follow-up on that one, which is a bit punchy, but what's your sort of kill switch decision on this? So let's say you've got a holding and all of a sudden the share price suddenly drops. What evidence would make you go, yeah, okay, I've got this wrong. I need to get out of this now.
Well, I try not to be driven by share prices. So I think, yes, share prices do often tell you something. I mean, obviously, if a share price halves, there's probably a reason for that. Or if it's going up a long way, again, there might be a reason for that. But I think probably investors tend to read too much into share prices. So, if the share price was going really well a few years ago, does that mean that the risk is lower or higher? And the share price is falling now, does that mean the risk is lower or higher? I think it all comes down to the business itself, and you really have to understand. I'm very focused on how the business itself is performing. So with a business like Relx, the share price has done horribly the last year, but the business is doing well. They're doing the right things, and it's got lots of competitive advantages, which I think can probably help it with the AI threat. And they're the things that I focus on. I don't focus so much on what's the share price done. It's dangerous sometimes to read too much into share prices because you can end up being scared out of them at just the wrong minute. If the business fundamentals are deteriorating, or are likely to deteriorate, then that's a different kettle of fish. But it's all personal preference, I suppose. It is difficult with a lot of these businesses to say how much of a threat AI is, so that it does make it hard. But focus on the business, focus on the cash, and at some point the valuation gets to a level where you think, even if this is disrupted, actually this makes sense to hold or to buy more of this business. So you have to weigh everything up, and that's why it's so hard. There's no formula that I can give you other than focus on the business. Don't focus on the share price.
That's a very good point indeed. Charlie, I want to ask you something about you touched on before about businesses that you avoid. Now, this is quite an important bit because we've all got our own biases. We talked about biases earlier. And you were saying that you avoid miners. I think you were saying so. And given the strength of what they've done in the past year, and I know it's not about short term what doing it over the past year, but given the lull they've been over the last 10 years and the last 2 years have been significant performers, miners throw off a lot of cash when prices of the assets go up. The larger ones pay dividends as well, so you're getting an income from them. Is there anything historically as to the reasons why you've technically or fundamentally avoided the mining stocks?
Well, I think timing is crucial with miners or any oil mining. These sectors just tend to go in waves of either they're in favor or they're
Super
not.
cyclical, yeah.
Very, very cyclical. The time when they look best to own you probably is the time when you probably don't want to own them, and the time when they look worse to invest in is the time. So you have to be counter cyclical in your behavior. And they are very capital intensive and often, to be honest, not very well managed. So when commodity prices are going up, all the miners want to invest, and when commodity prices are going down, they stop investing. Well, they should probably be doing the opposite, because when commodity prices are going down, that's when it's cheap to open more mines and to buy other companies. And so, again, it comes back to the human behavior thing. Investing is hard enough without investing in, to my mind, highly cyclical businesses where timing is everything. And I have no idea what Rio Tinto will be earning 5 years from now, because I don't know what the commodity price will do. I'm not in any way disparaging people that invest in miners. I think there's very much a place for them in a portfolio. But I just know that for me, that's not the right thing to invest in. And it always goes in cycles. I mean, do you remember, was it 2010 or coming out of the financial crisis? It was all about the brick economies, and it was all about China, and commodity prices were going to keep on going to the moon forever. And they did for a time, and then suddenly it all changed, and everyone said, "Oh, China's never going to invest again," and the BRICS suddenly didn't become a term. Like most sort of younger people watching this won't even know what I mean by brick economy. And now we're seeing, AI. AI is a great thing. We're going to need loads of commodities. We're going to need loads of copper for AI. So copper price is going to keep going to the moon forever. So to me, looking at it as a sort of outside observer, it seems like quite a risky time to invest in commodities. But it could go on for another few years. But and they've been out of favour for quite a while, so maybe it will. But you look at the results from, I mean, I looked at Antofagasta's results the other day, and they're actually generating negative free cash flow because they're investing so much, because they're so sure that the copper price is going to keep going up. So yes, they generate a lot of operational cash flow, but after all their investments, they're generating negative free cash flow. So just not the sort of businesses that I want to own, really.
Oh, that's cool. That's cool. Let's talk about the companies that you do like. You've already mentioned a couple of them, and you've written blogs on them already. We need to share with everybody where they can find the blogs as well, when you finished answering this question. So stocks that you like, stocks that you're already invested in, which your boss knows about, the wife, Mrs. Huggins, knows about. So some of the stocks you like, and the reasons why you've chosen them, and how long you've been invested in them, please, Charlie.
Yeah, I mean, I think the safest thing to do at the moment, if you're worried about AI and you're unsure about AI, is just to largely avoid AI. So if you avoid stocks that are seen at risk of AI disruption, and you avoid AI itself, the AI winners, where does that leave you? And there are some interesting industrial businesses, some of which have a bit of exposure to AI through data centers or whatever, but it's very hard to see. So a business like Diploma, which is a distributor of seals and controls and medical equipment, gaskets, things like this, it's very hard to see how AI would disrupt a seal going into a piece of heavy machinery. I mean, it could happen, but it's very, very hard to see. So that's a business that I think I feel happy owning at the moment, given that I don't really need to take a view on AI. And it's a business that I've held for many years. The reason being that it is a very good acquirer. So it's a serial acquirer, a very disciplined acquirer. It's acquired some fantastic businesses and it's sold off a few businesses as well. And it's just got a really high quality portfolio of industrial distribution businesses. And their products are critical. They are operating in fairly specialist and niche markets, and the management team are very sensible, and they have plenty of growth opportunities, both organically and inorganically. And it's a business that just tends to grow every year. If we had a massive recession, probably they would go backwards. I think they went backwards a bit during COVID, but they bounced back even stronger. And it does have a little bit of AI exposure to data centers. So you're getting a bit of positive tailwind there, but not too much, if you like. So that's a business that I've owned for a number of years and still like. And then in terms of the more at risk of disruption, but probably not at risk, in my view, is a business like Experian, which is a credit bureau. The data that they have is highly proprietary. Credit data, it's not publicly available. They get data from their own customers. It's a very strange business model that the customers sort of give the data to Experian. So it collects all this data from all the banks and then it sells it back to them. And they use it to make, again, critical decisions like lending decisions. So I do not see how large language models could get access to that data. To try and replicate that business would be almost impossible, I think. And it's not just them, it's Equifax and it's TransUnion as well. But the thing with Experian that I like is that they've been making long-term investments for the last decade in broadening out their range of solutions using data in more intelligent ways and just becoming more and more integral to their customers. And it's a business that, again, every year it tends to grow, and it's not as cyclical as you might think, because data is used not only for new lending decisions, but to manage existing portfolios of loans. So it's very sensibly managed. They've done a very large scale transformation, modernization of their technology estate over the last 5, 6, 7 years, which is now coming to an end. And that means that margins which have been held back by all of those investments should start to make more meaningful progress now. So I think you've got a nice top line growth story with margin progression as well. Investors are worried about the AI impact on Experian. I think personally, I just don't see it. I don't see it. I think they will have to invest more in AI and launch their own AI solutions, but hopefully they can monetize them. And yeah, I think for the next 5, 10 years, I just see that business going from strength to strength.
Whether you are an experienced or new investor, you know how valuable it is to conduct portfolio enhancing analysis and to have easy access to data that will give you the edge. As a Twin Peaks investing podcast listener, you can access an exceptional offer, the UK's #1 investment data and analysis software for private investors and traders. This special Twin Peaks offer is available to new subscribers only, and you can subscribe using the promo code TWINPETES. The incredible and exclusive offer means that monthly subscribers will get their second month free, and annual subscribers will get their 13th month free. Sign up and subscribe today using the Twin Peaks promo code, and you can save up to £69. Visit sharescope.co.uk for further details and subscribe to the investing and trading analysis and data you need.
Thank you for that. I'm not sure if anybody wanted to ask a question regarding that. I was going to ask regarding the Experian one, because that's been on my radar forever. And I've just seen it getting smashed, and I'm already in Relx. And just for our global audience here, I booked speaking to Charlie good few months, probably 2 months ago now. So we ended up speaking about Relx and we both own it. It's just a coincidence. But Experian, I've had on my radar for a while. I'm sitting there thinking, I've got enough Relx up now. I'm just going to watch and see what happens and see when it plateaus, regarding it. I'm absolutely on point regarding its moats, its data, its all the stuff that it's got, which others can't have, and they're not just going to just outsource it because it's personal details in everybody's data. But it doesn't seem to want to plateau or find a bottom, because the markets are sitting there worried every 2 minutes, up 1%, down 2%, up, down 2%.
And it's hard to, if you already own, I mean, all of these companies are being lumped together.
Yes,
so the Relx,
exactly.
the Experian, and you see on any given day, if Relx is down 4%, then Experian's probably down 3%. And
Absolutely.
so from an aspect of diversifying a portfolio, maybe if you're worried about day-to-day volatility, the businesses themselves, yes, there is a little bit of overlap in terms of fraud, software, but what the businesses actually do, yes, they're using data, but they are in different industry verticals and different customer bases. Relx, they both have exposure to financial services, but they're both very diversified businesses in their own right. And it could be the case that one is disrupted and the other one isn't. So I do think from a business perspective, it does give you some diversification, but I accept that they are being lumped together at the moment. And given the choice, as I said, that's why I mentioned the industrials, because I think the temptation might be to say, you know what, I'm just going to add an industrial because I've got enough AI. I've got enough, AI loser exposure at the moment.
Yeah, no, I get that. And Henry, go ahead, mate. You had a question.
I mean, it's not so much a question as a sort of follow up on Experian. I mean, ironically, you've mentioned Relx, which I don't hold. I do now hold Experian.
Oh right,
Is
that a new buy, Henry? Is that a new buy?
New buy this week.
Okay.
So by the time this goes to air, I will own it. So you've managed to sink both our battleships there. So
Yeah.
Congratulations.
Yeah.
I mean, a little bit like you, I'm a little bit wary with Experian. I've opened up a small starter position. I mean, to me, when I was doing my research into the company, I've always liked it, but there are bigger risks than just the AI disruption. Last month, for example, I think the US, is it the US Credit Protection Bureau, the Credit Financial Bureau, has sued them for failures around investigating credit report disputes. So there's a sort of legal case going on with the US government, which I'm not hearing many people talking about at the moment. That can create some uncertainty around the share price. And that's, to me, a potential red flag, because it becomes a bit of a binary outcome. If things work out, the share price might recover. If they don't, you could expect a further drop in addition to the AI. And you've also, looking forwards, we're talking about the risk of a recession occurring. So nobody is talking about a recession, and we're sort of due one. You typically have one every 5 to 6 years, or whatever the figure is. Now, Experian's kind of intrinsically linked to credit conditions. When the economy is doing well, more people are borrowing money, and therefore there are more credit searches being run. If we tip into a recession, that's probably going to go into reverse. So although I've just opened a position in Experian, I think the story around it is actually slightly larger than just the AI story. Now, my question for you to follow up on that one, is there a particular sign you'd be watching for at this stage to go, yeah, I think the business is going to drop further before it falls? Or a signal that you could point out for our audience, or me in particular, that might indicate there's a big drop on the way?
I think you just have to value the business. As I say, I use discounted cash flow, and you can say, okay, based on those cash flows, what I think they're capable of doing over the next 10 years, this is what I think the value of the business is. Now, personally, a business like Experian, I think, should be able to do around 10% profit growth each year for the next 10 years. So when I'm valuing the business, in my discounted cash flow model, I have 10% profit growth over the next 10 years. And when the economy is a bit better, it might do more. When the economy is a bit worse, it might do less. But that's what I have, and then a 2.5% terminal growth rate. And if I run those figures, the intrinsic value is a lot higher than what the current share price is. Obviously, my forecast could be completely wrong, and anything can happen in the next 10 years, and so don't rely on it. But that's the only thing that I have to come back to ground me in reality, if you know what I mean, to say. And then it's all the judgment of, okay, how much upside do I require? Do I want 50% upside, 100% upside, a 30% upside to what I think this business is worth? And at some point, you just have to say, nobody will raise a flag to say the share price isn't going any lower. You just have to buy.
I wish they would. I wish there was a little feature that the London Stock Exchange.
I know.
That would be handy.
On the risks that you mentioned, I think you're right. Regulation and the economy are probably, outside of AI, probably the two risks for the business. I don't consider them big risks, though. I think regulation is always more of a perceived threat than reality for Experian. The reason being, I mean, Trump administration has also come out and said it's going to put a cap on credit cards, which has also hit the share price. There's always something. A few years ago, the US wanted to, or there was rumors they were going to launch a public credit bureau, and that, sent the share prices down. If you look historically, all of this noise around regulation, it hasn't made a dent on the business. And the reason for that is because Experian is so critical to the functioning of an economy, that if you're a regulator and you want to change the status quo and you want to change things, it's incredibly risky. And at the end of the day, businesses, banks will always find a way to lend, and consumers will always find a way to borrow. And as long as consumers are borrowing, then you require the credit bureaus and Experian. So regulation historically has not made a dent on the business, and I struggle to envisage anything that would make a serious dent from a regulatory perspective. Not to say there won't be loads of noise, because there will, and that will send the share price down every so often. On the economy front, they didn't sail through the financial crisis, but they came through the financial crisis pretty well. And that was just about the worst event you could ever imagine for a business like Experian. And I think their profit was down maybe 10-15%, something like that. And I think organic revenue growth was actually positive in 08-09. I don't think Experian has ever had a year of negative organic growth. Partly in the 08-09, that was because the Latin American business did well, and that offset declines in the North American business. So again, diversity, very important, because the Brazilian economy often performs completely differently to every other economy, it seems. Recently, badly, but that will turn at some point. So the business isn't anywhere near as cyclical as you think it should be. And that is because, as I said, Experian's products are not just used for new lending, they're used for managing portfolios of existing loans. And when credit conditions deteriorate, banks really want to know, tell me more about this customer who we've lent to him, and so they get more data to help them with those sort of decisions with delinquencies. And the other thing that Experian have done is just diversified into areas that are not linked to the credit cycle in anywhere near the same way. It's an extremely diverse and broad business that some parts actually do quite well in a recession, such as the consumer business, the subscription side of the consumer business. So it's a complex beast, but in terms of cyclicality goes, there are many other businesses I'd be more worried for, put it that way, in a recession.
You'll be pleased to hear I largely agree with that. So fingers crossed it pays out in 10 years' time. We'll have to have a 10-year anniversary episode.
Brilliant.
We'll see. Yeah, that's the thing with investing. You just never know. You have to come back in 10 years.
Anything can happen.
Yeah.
Now, Charlie, I'm conscious I had you on here for a little while. We've got a large cohort of investors who are private investors, who are also institutional investors, and there is a need and sought after for income. And you mentioned earlier, I think you did, if I'm hearing right, that you have some income producing assets. Can you talk us about those, any of those that you've got, the reasons why you've chose them, and the security and the lack of the lower risk aspects of them as well, please? Because
sure.
There is a thing about dividends, that people like the security blanket of every 6 months or every quarter there's some dividends dropping in and some income coming in. Oh, Henry's
Yeah, sure.
yeah, yeah.
Um, yeah. Phew. I'll mention. I mean, one that I own is Primary Health Properties. So
Okay.
it owns doctors' surgeries, or large primary health care centres. Not the sort of tiny little doctor's surgery on the corner, but the kind of bigger GP primary health centres. It
Yeah.
has very long-term leases with its customers. Obviously, most of its income is government-backed. It's just acquired Assura, its nearest competitor, so it's now got greater scale, which scale is not always an advantage, but when you're knocking on the bank's door and asking for money to borrow, they'll often give you better financing if you're bigger. So I think that's one of the reasons that they did that. I think it's yielding around 6.5% still. It has had a good run recently, so maybe now is not necessarily the perfect time to buy them. But if interest rates continue to come down, if bond yields edge down, then that will be helpful. And it's still a 6.5% yield. In terms of recession resilience, you can't get a lot better, because obviously people still go to the doctors when it's whether it's a recession or not, maybe more so in a recession. And in terms of growth, you're not going to see explosive dividend growth, but you'll probably get about 2.5%, 3% a year. So if you add 2.5% to 3% on 6.5%, it's not a bad annual return. Obviously, when interest rates went up, all these REITs got smashed. So if you look at the 5-10 year chart, you'll see that Primary Health Properties is still well below where it was 10 years ago, and it's just started to recover. That to me seems like a fairly low risk income option.
Brilliant. Love that response. I'm conscious again of the time, Charlie, so I'm going to just rush through this last couple of questions to you. Given the fact you were at Hargreaves Lansdown, which got taken over, last week we saw Schroders being acquired by Nuveen. I think that's how you pronounce it. And now you're outside looking in. What are your thoughts about the active management industry? What's it looking like? If I gave you like a 10-year lens or a 5-year lens, what's your thoughts on the fund management industry going forward?
I think there'll always be a place for active management. It'll always be around. I think it's had a horrible time the last few years. Everything's been passive. Everyone's gone to passive, which I understand, because passive is low cost, and it's really hard to find and to identify good fund managers. And if you can just own a passive, then why wouldn't you, really? But I think a lot of active managers have really struggled recently. Look at Terry Smith, look at Nick Train. And that just increases the demand for passive even more. So many active managers have struggled. Passive has just become absolutely huge, and the bigger it gets, it leads to even more irrationality that we see in the market, because all the stocks that are going up get bought more of, and the ones going down get sold. But I think we're maybe near it. We saw the same in the late 90s. In passive trackers, everyone wanted to own NASDAQ tracker because it was doing so well. A lot of active managers were shunned. I think Berkshire Hathaway underperformed by about 50% in the late 90s. But then things changed, and when the bubble burst, active managers did really well again after the TMT bubble burst, and maybe the same will be this time. But I just think at the moment, absolutely horrible. It's just a horrible environment for active managers, and of course, to things like private markets, and they're just trying to get away from traditional asset management. I think the other reason, and this is a very valid reason, is that a lot of active managers have just been closet trackers. And why would you pay 1% to own a closet tracker? It's stupid. So I think that's great that they've been killed because investors have taken the money out of them. That's great, but I personally would be nervous about putting everything into index trackers and completely avoiding active managers, because the point when you want to do that most is the point when it's least likely to be a good choice. You know what I mean?
Very, very good point. Yeah, absolutely. I agree. Thank you for that reply. Henry, one more question, and I'm going to ask the final one to Charlie. Thank you very much, Charlie, for your time as well. I appreciate it.
Well, I've got a really quick one for you here. So, in a sentence or two, what do you think are the best and worst reason for buying what you define as a quality stock?
The best and worst reason. The best reason would be that you think the business can endure, because a quality business is one that should endure and prosper for decades. So if you find a business that you think this will endure, that's a good reason for buying the business. And a worse reason for buying the business is that the share price has gone up or down.
I'm really pleased you answered that, because you could have stolen that from my blog.
Brilliant. Thank you ever so much, Charlie. Charlie, where do people find you? Where's your blog? Are you on LinkedIn?
Right. Yeah, I'm on LinkedIn and Twitter.
Yeah.
Charlie Huggins. Just search for me on there. And then my blog it's the Fiercely Independent Investor is what the blog is called. And the website address is charliehuggins.substack.com. So it's a Substack blog. I have free and paid for content. There's plenty of free content on there, and then there's also some paywalled content as well. But as I have plenty of free subscribers, and if you're just looking for my views on a few different things, you'll find them all on there, basically.
Brilliant. Can you tell some of our listeners which sort of companies you've recently written about, so they get a flavour of what sort of things you're talking about, please?
Sure. So I've done articles on just the general market environment, which we've spoken about today, Diploma, AI, serial acquirers, big long articles on serial acquirers, Rightmove and Auto Trader, Fundsmith. So sometimes I'll write about funds as well. One of the joys of having a blog is that I can sometimes just write about things that I find particularly interesting. So I wrote an article on, is it time to give up on Fundsmith? I wrote on Relx and what Anthropic's legal launch means for them, Compass, and my most recent one was just an overview of Relx's recent results. But it will be predominantly focused on UK quality businesses, but also some global names as well.
Brilliant. No, thank you ever so much. Ladies and gents, we hope, we know you're going to love this particular podcast. Charlie, you've been absolutely fantastic, mate. Really, really appreciate you being on. And you can find Charlie on X at Charlie Huggins, just a little underscore underneath the last bit of his name. And we will get this podcast out on Friday, the 19th. Please follow Charlie on X. Please go and subscribe to his Substack as well. And if you're on LinkedIn, find him on LinkedIn as well. We're going to keep a track of and continue to support Charlie on his journey as a private investor, because bizarrely, Henry and I, well, maybe not Henry, we've got probably more experience as a private investor than Charlie has because he's been mainly a fund manager. So we're going to be here, Charlie. So anytime you want to have a chat with us again, you're more than welcome to come back on the pod, and I'll keep in touch with you anyway.
I'll be asking advice from you, definitely. No, just that's been great. I really value your support, Peter. You've been a huge support for me throughout my whole career, which has been very much appreciated. And Henry, I really enjoyed our chat. I mean, some great questions there, and hopefully we can do this again. I really enjoyed it.
Thank you ever so much, mate.
You on, Charlie.
All right, we're going to call that a wrap. That's the close of podcast 173. It is just gone 7 o'clock, 7:15-ish. Charlie, we'll see you soon. Take care. Love to the fam.
Right.
And the little one. We didn't speak about the little one. We'll have to do that next time now. How old is she? He?
14 months she is now. Yeah. So she's not slept at all the last 4 weeks. So sorry if I'm looking slightly tired.
Wow. Right. Okay. You have to get some rest. Lots of fresh air helps them to sleep, apparently.
Absolutely.
Yeah.
All right.
Classics for babies. Yeah, get them to play that before they go to sleep. Really, really good.
And as you said when we spoke before, Calpol.
As my daughter was sponsored by Calpol as well. Absolutely. All right. Okie dokie.
Cheers, Pete.
Very welcome, mate. Ladies and gents, take care. Look after yourselves. Show kindness to everybody that you possibly can. Look after yourselves. All the very best. Bye for now.
Thanks, Emery. Thanks, Peter. Bye.
Bye-bye.
Twin Peaks Investing Podcast is brought to you in association with ShareScope, the UK's #1 investment data and analysis software for private investors and traders. Visit sharescope.co.uk and discover the advantage.